All right, let's get started. So welcome everyone to this Yale blockchain webinar. We're so excited to have all of you here. And I'm very honored and excited to have Alex Lipton here speaking with me. He's the head of quantitative research at the Abu Dhabi Investment Authority, and he's also done a number of amazing endeavors across the crypto and blockchain space and quantitative finance in particular. I'm Diana. I am a 2017 SOM grad, and I've been in the blockchain space since around 2017, from advising regulators to AML to investment banking in the space. So excited to talk to Alex here. Welcome, Alex.
Thank you, Diana. It's an honor to speak with you and to be able to present some of my thoughts to the audience. So I hope it would be a lively discussion. One word before we start. Needless to say that I represent my own views and not necessarily the ones of the Abu Dhabi Investment Authority.
All right. So first of all, could you tell us a little bit about you and your journey in the blockchain space?
Oh, yes. Well, my journey started way before blockchain was even conceived, yet alone implemented. And I was born in Moscow. You know, nobody's perfect. And I came to the United States about 30 years ago as an immigrant. I worked at MIT on thermonuclear fusion. I worked at Los Alamos and other things related to thermonuclear fusion. I was a full professor of mathematics at the University of Illinois. And since 1997, I became a quant in a variety of investment banks and a hedge fund. So I worked at the pioneering derivatives powerhouse called Bankers Trust, and then at some other banks. Then I worked for a few years at Citadel in Chicago, and then I went to Merrill Lynch in London, where I stayed during the financial crisis when the bank was acquired by Bank of America, and I stayed there and became the co-head of the global quantitative group responsible for the entire derivative operation of the whole firm worldwide. And then in 2016, an entrepreneurial bug bit me and I wanted to build a narrow bank. That was not an unqualified success, but in 2018, I managed to co-found a company which is called Sila Money, which is still going strong. And it is using some of the ideas of a narrow bank and things like that, and blockchain in order to, essentially provide payment services for business entities. And then in parallel, I have been doing all kinds of scientific research. I was an honorary visiting professor in too many universities, but Oxford, for example, and the Imperial College, École Polytechnique in Lausanne, and then for the last few years at the Hebrew University in Jerusalem. And more recently, I have joined the Abu Dhabi Investment Authority as a global head of research and development. And my main responsibility is portfolio oversight, as well as tokenization, and also climate change for a good measure a little bit. So that's my trajectory. But, in the beginning of my career, I did applied mathematics, and then it switched to financial mathematics, and I stayed in this field ever since. Yeah.
I love your overlapping interests in blockchain, cryptography, financial innovation, and also ESG. You wrote a book that I have here with me on blockchain and distributed ledgers, which is a fantastic overview of all of these emerging technologies, which I would recommend. So why don't you take us a little bit of time to walk us through some of the main topics of your book, from basic blockchain concepts, what's distributed, what's decentralized, and what is money?
Yeah, wonderful. These are all interesting questions. First of all, I want to point out that the book I wrote jointly with a very talented guy, Adrian Tricani, who is the CEO of a blockchain security firm called Metacon in Lausanne. He and I taught courses together at the École Polytechnique, and essentially this kind of a broad kind of development of the ideas which we first put forward there. So the book covers several topics which are close to my heart. So the first one is what is money, and how it evolved over a period of millennia, what it really means, whether it is defined by law or by coincidence of needs and all that type of thing. Then it switches to the broad overview of how blockchains operate and what cryptocurrencies in particular can do for you. Then there is a chapter which covers cryptography as such, and it goes into some detail, not a particularly deep detail, but some detail of how symmetric and asymmetric public-private key cryptography operates, what is an elliptic curve cryptography, and things of that nature. So essentially, without too much effort, even though with some effort, you can understand exactly what is the mathematics underpinning this whole edifice. Mm-hmm. If you are not mathematically inclined, you can take my word for it, but if you have an inquisitive mind and I would say a bachelor degree math, you should be able to understand that. And the message which is kind of central to this chapter 4 is my own aphorism. As they say, one of my favorite authors used to say, such and so is so uneducated, he is forced to inventing his own Roman antiquity quotes. So this is a quote from myself. So where I said that cryptography is not an art of finding a needle in a haystack, but a needle in a stack of needles. So that's probably how it is. It's actually relatively simple from a mathematical perspective, so to speak. Every individual operation is very, very simple, but the number of operations is comparable to the number of molecules in the universe, and that's what makes the whole problem so difficult. Anyway, however it might be, in chapter 5, we go into actual detailed description of how Bitcoin protocol in particular operates. Chapter 6 covers Ethereum, chapter 7 Ripple, and I have to say, you'll probably gather it from reading the book that I'm not a big fan of Ripple, to be perfectly honest. I find it lacking in revolutionary spirit, to be honest. But anyway, so then chapter 8 covers something which I'm sure is close to your heart as well as it's close to my heart. That is stable coins.
Yeah, we'll talk about that.
Central bank digital currencies and things like that. Chapter 9 is quite important, but somewhat technical. It really covers this pesky question of how to protect one's private keys. Surprisingly, given the sort of 21st century, structure of this protocol, the actual storage of keys can go all the way to the 16th century, where you can actually have to write it on a piece of paper, cut these papers into smaller pieces, store every small piece in a separate safety box. All in all, it's a holy mess, and that's a weak part of the whole thinking, because it's super hard, pretty much at the border of what modern technology can do, saving securely private keys, so on a computer. And then we cover some of the mass finance applications. That's kind of drawback to my time as a head quant. So it introduces a few stochastic processes and analyzes Bitcoin domination, and also uses epidemiology in order to describe various kind of behavior of different cryptocurrencies and stuff like that. Actually, it's very interesting. I started to work on that before the COVID, and so when COVID struck, I had an opportunity to write a couple of papers about modeling this disease, but it was based on my analysis of cryptocurrencies and not the other way around. So that was, I wouldn't necessarily call it fun given the grim nature of the modeling itself, but it was an extra demonstration, if any demonstration is really needed, of inexplicable efficiency of mathematics. So anyway, and then chapters 11 and 12 cover various applications of blockchain technology, not so much cryptocurrencies themselves, but blockchain technology to various important topics of modern day, including a little bit on NFTs, not as much as I should have written, but at that time it was somewhat underdeveloped. And finally, in the last chapter, we outline our vision for more complicated blockchains. Blockchain interoperability is something which I have been working a lot with my colleagues at MIT, where I'm a fellow, and things of that nature. So that brings you to the whole kind of the end of the story.
That's fantastic. And that's fantastic what you say about, because I know that you have a very deep insight on financial market infrastructure, the implications on systemic risk, and really how to modernize the financial system that we live in from a standpoint of the underlying infrastructure. So what are your thoughts on the most important needs today?
Well, look, I mean, this question could not be timely, if you wish, because right now we see under what kind of strain the whole infrastructure is with, sanctions imposed on Russia and things like that, discussion of switching off SWIFT and things of that nature. So putting aside, the kind of sanctions and stuff, and strictly sticking with the infrastructure itself, it looks to me that the centralized infrastructure is really, under tremendous stress, right? The demands on it from the development of, e-commerce in general, sort of moving people more and more into computer kind of centric business activity, potentially into metaverse. Exactly. So that really sort of does not fit well with the way the structure we know kind of currently operates, because we see that certain things develop from the kind of side, very, very differently from the nature of this infrastructure, coming essentially from digitization of what was essentially manual operations and things like that. So we really could potentially benefit if it is done with finesse and very proper understanding of what it is we want to accomplish and how we want to accomplish from decentralized financial infrastructure. To what extent truly decentralized infrastructure can be successful, it's anybody's guess due to the complexity of the undertaking, which would probably have no analog in other people's endeavor, even though, as you know, kind of people have solved so many amazing problems, but, this one is probably more complicated than any other. But, certain modicum of decentralization, increasing simultaneously the resilience of the system would certainly be very, very welcome. And from that perspective, I think that some of the protocols which have been pioneered by Satoshi Nakamoto, who she or he or they are, nobody knows. But, that certainly is an example of what we can think about, even if we can.
The concept of not having a central point of failure through distributed or decentralized systems, and the concept of having a payment system that's more efficient with respect to clearing and settlement, and all the frictions that intermediation can be resolved in many ways. You've had some very interesting insights in the realm of central bank digital currencies. Could you tell us your thoughts on the latest experimentations and also opportunities?
Right. Well, they're both opportunities and danger, and it sort of depends very much from whose point you are kind of presenting that, but the idea is that in principle you can try to digitize cash to a certain degree, and one has to understand that in some countries more than in others, but most developed countries and many developing countries, money is already by and large electronic, right? So it's stored in banking accounts in form of electronic records, and it being communicated from account to account in the electronic form. However, in some countries, including the United States, cash is still playing a major role, even though this role is gradually diminishing. And so it is only natural to ask if it is feasible, desirable, and useful to replace the remaining cash by some electronic analog, which would sort of serve the needs of 21st century commerce and things like that. So different countries pursue different avenues. I would say that China is probably the furthest down the road, but it is important to understand that the Chinese and digital currency is not strictly speaking blockchain oriented. It is based on other cryptographic principles, and so as such, one can argue whether or not it's a CBDC in the strict sense of the word, where kind of the importance of this, CBDC living on a blockchain one way or the other is important. So other countries, smaller countries, are trying and experimenting with that, and I would say that the United States, is not exactly behind, but certainly there is a major obstacles, both political, if you wish, but also philosophical, to whether or not it's possible. But some of my colleagues at MIT, jointly with the Boston Fed division, are exploring some of the possibilities. That's one direction which I know.
Right. It's important for different countries to really prioritize what they're going to embed into the design choices of central bank digital currencies, because there are many options, whether they be wholesale model, which could be more resembles traditional model where commercial banks would have an account at the central bank, as opposed to a retail model where individuals could directly have accounts at the central bank and access central bank money, which would be a new model, to be able to have a digital wallet potentially on your phone and say, oh, I have an account at the Fed or whatever central bank, depending on the country where you're at. And the different design choices with respect to account-based, token-based, or the privacy considerations and security considerations. It's a whole realm of topics. And like you said, China has released their white paper and made progress on their CBDC, and CBDCs may or may not run on blockchains. Yes. The United States released their concept paper on what they would envision, and also the innovations with Project Hamilton, but also other countries. With respect to the role of central bank digital currencies, and I know you talk a lot about narrow banks. Could you define for us what narrow banks are and why are they important? What's their role?
With great pleasure. I mean, that's my favorite pet concept, and I'm happy to talk. But of course, by no means I am the inventor. In fact, if I were, then I would be 400 years old, which I'm not. And this idea have been central for the typically it appears in the beginning of financial system becoming based on banks, then it sort of disappears and then reappears and so on and so forth. But let me explain first what the concept of a narrow bank is. The narrow bank as such is just an accounting vehicle, if you wish, right? So all it does, it takes people's deposit or companies' deposits and then invests them solely in the central bank cash, or some extremely stable instruments like short-term government paper and things like that. So essentially on the asset side, it has extremely non-risky, ideally kind of completely non-risky instruments. On the liability side, it has some capital which is needed even if assets are totally non-risky, and just because operational failures cannot be excluded under any circumstance. So unfortunately, banking and operational failure always come hand in hand, and so that's why you have to have a cushion, capital cushion, in order to be able to cover the slips and stuff like that. But why is such a bank useful? Essentially because it's completely safe, and that might be a natural emitter of central bank digital currencies. The same way as governments do not necessarily produce their own weapons, preferring buying them from from private parties, private contractors. The same way governments can outsource production of central bank digital currency to narrow banks. It's very, very important. Like under normal conditions, the probability of a major bank defaulting, of course, is relatively small, though never non-zero. And for example, during the global financial crisis of 2008, 2007, 2008, some of the very major household names have, probability of default, in the hundreds of basis points, like 10%, 15%, 20%, which is a lot. And some of the banks actually did default, including Lehman Brothers, even though it was never sort of a commercial bank in the strict sense of the word. But the point which I want to make is that narrow bank is a natural vehicle for the emission of this type of stable coin. And returning back to your question and pointing that one of the, so we have to discriminate between wholesale CBDCs, which essentially are kind of internal tools for internal settlement of kind of accounts between banks, and as such are not particularly revolutionary, because that is already happening through the FedWire and other systems like that. And essentially, but what is important to emphasize is that accounts in different banks cannot really communicate directly with each other. So money which is held at, say, Chase Manhattan Bank is not equivalent to money which is held in Citibank, for example. And in fact, I'm afraid to disabuse our listeners, but when you say that you have some money in the bank, it's a little bit of an illusion, because in reality, and the kind of the Anglo-Saxon law, the British law, which actually operates in this country as well, is that if you're a depositor in the bank, you're just junior unsecured depositors. So essentially, you don't have any money. So, but it's just a claim. And so essentially, two banks can communicate with each other through a lingua franca of the banking system, which is essentially central bank digital currency. So that's how system operates. And wholesale CBDC facilitates it and replaces a FedWire by another system similar to it in spirit. And there are several companies, as you know, which are pursuing this. So for example, Clearmatics, Finality, and a few others, which is that. With retail CBDCs, if they ever come to fruition, it would be completely different, as you said. But assuming that people will have direct deposits with central bank is probably a little optimistic, for a very simple reason. However mighty they are, central banks are very small. Say maybe tens of thousands of people working there versus hundreds of thousands working in major commercial banks. And so they're not really equipped on producing something close to your heart, which is anti-money laundering, know your customer, and so on and so forth. So that's why, in all likelihood, if retail CBDC were to be issued, then it would be issued through the good offices of narrow banks, or probably for lack of narrow banks in reality, they would be issued through the strongest commercial banks, and ideally, this amounts collateral in the form of cash should be really separated from other activities of the bank. So at least, if a bank were to default, God forbid, because a default of a major bank will, it will be a major blow for any economy, right? So if this were to happen, this collateral would be separate, and there would be no claim by other parties to this collateral and whatnot. But so essentially, we have to design a system where collateral and its digital representation go hand in hand, and never there is a separation between the two.
That's very clarifying. Thank you. What about the role of anonymity and privacy, as opposed to the perception of CBDCs giving access to people's information through to governments, as opposed to crypto, other more anonymous forms of crypto?
Diana, this is a super important and very deep question, and I have been struggling with it for a long time, because we need definitely to draw the line between, legitimate, usages for, digital currencies and stuff like that versus the nefarious usage. And from that perspective, we need also to draw perhaps some sort of a threshold underneath. Transaction should be anonymous and, like just going the same way as cash, right, warts and all, versus higher amounts which have to be announced, disclosed, monitored, and much like happens right now, when you try to pay for something more than $10,000 in cash, this transaction would have to be reported to the Fed and all the types of things. So it is very important question to which I still don't have 100% satisfactory answer, but my leaning is right now to have a certain threshold and preserve anonymity. And you can imagine that preserving anonymity was a double-edged sword, but same as cash. If cash were to be invented today, it would probably be not allowed by regulations and so on, because it's an ultimate vehicle for preserving anonymity and making all kind of transactions. And in reality, in many instances, actually operating with cash is more difficult than operating with merchandise. Right. So it's an open question, but we have to find a golden division between the needs of privacy and the needs for control and fighting financial crimes.
Mm-hmm. What about moving forward? We're getting a few questions, and we always get questions on the investment trends in cryptocurrency and blockchain. Where do you see the role of Bitcoin as opposed to so many other cryptocurrencies that have come up, as well as use cases of blockchain technology?
This is very interesting. So first of all, as I said, I cannot recommend or not recommend any particular cryptocurrency, and and I will not do this. I will only say that Bitcoin protocol had been a marvelous technical invention and very, very impressive in all kinds of things, not least that it had survived pretty much in its original form, maybe a little modified, but not by much, since its inception had been constantly attacked, by all kinds of parties, trying to extract financial gain out of it. But the underlying protocol has never failed, whilst of course numerous exchanges built to sort of facilitate usage of this protocol have been attacked and cracked. And you probably heard recently the biggest seizure in US financial history, $3.5 billion worth of Bitcoin was seized from some rather unpretentious couple, and
yes.
through through gift cards, you know, at Walmart, so, which makes one think, what's the point of sort of stealing, you know, several $1 billion if you want to spend it at Walmart, and on what, you know, what for? But anyway, so putting this aside, so I think that this was a pioneering discovery. You might like it, you might not like it. Clearly, it has a lot of, you know, problems. You know, energy consumption being the most obvious, but you know, the inability of actually using it as designed, in other words, being able to communicate directly between you and I, for example, for the purposes of sending or receiving value, because you actually have to become, you know, to get Bitcoin, you have to become a customer of a centralized exchange, which sort of, you know, blows a big hole in the
not as decentralized as we think.
Yes. Precisely. It's not nearly as decentralized as we think, and still it's an amazing discovery. But I think the same way as all kind of things came and go, so will probably Bitcoin. Look, who am I to actually draw, you know, make a really solid prediction of that? But in principle, if you look at vinyl discs, they were marvels that they were invented, right, by Edison and other people, right? So his master voice and all that type of thing, and then they were replaced by other medium, and then yet another, and now it's an MP3 files. And you know, where are the discs? The discs are being used by some aficionados, and rightfully so, because they probably produce better sound, or at least people pretend that they produce better sound. But I mean, they certainly kind of substituted by new technology. I suspect the same destiny is in store for Bitcoin, just looking at everything else, right? So when the first steam engine was invented, it was really amazing, and indeed, you know, kind of these are marvelous inventions, right? You know, this trains, everything is being replaced by something, and that is the destiny of technology. The same way as we see probably the end of physical cash sooner or later, probably in a few years, you know, few tens of a few decades. Same is going to happen with Bitcoin. As far as Ethereum is concerned, of course, it's a much broader idea, kind of having many more facilities, but in
You
my
can build
mind,
things with Ethereum. And
exactly.
Bitcoin being the first of several innovations to use blockchain technology for a number of different use cases. What I find interesting about this space is that it changes at lightning speed. So there's always more innovations moving forward. So that's a good point.
Yeah. So, but as I said, with Ethereum, there are some other deficiencies, right? So the biggest one, as far as I'm concerned, are you know, the fact that it is, just one second, excuse me. It is that you know, this payment system within Ethereum is very archaic, and it was kind of built archaic design of paying per gas and gas,
right, and the role of the gas
operation.
fees.
This is really an Achilles heel of the whole protocol. And you know, like if you remember, you know, many years ago, telephone companies were charging by the minute or even by the kind of 5 seconds and so on. It was extremely irritating. But now, of course, you have essentially a subscription, right? So you can speak on the phone all you want 24/7, and it would be the same price, the same way. Like, for example, right now we're using Zoom, and you know, Yale, I'm sure, paid somewhat for the business, you know, version of the you know, protocol, but nevertheless, they're not charging you for this particular communication rather than a subscription. That's absent in Ethereum, and it can be very, very irritating, because that can make even simple transaction extremely expensive. The other thing with Ethereum is that you know, maybe rightfully so, but at any rate, it's extremely unforgiving system, right? So you have to calculate how much gas you need to execute a particular transaction, which is a difficult task. And if you sort of underestimate the number of gas, your gas will be burned, and then you will not execute the transaction. If you put, you know, too much cushion, then the transaction will not be included in the block, because there is a limitation of how much operations a block can can handle. So this is not the last word in this, kind of building of the evolved distributed computer, but it is certainly a major development. And then, there are several other kind of protocols which are, even broader and better suited for, essentially financial aspects than Ethereum. So yeah, I see a lot of progress, as you say. I don't think we had the last word in that, no.
So there are still a number of hurdles that we have to get through to really make it user-friendly, and from a, I want to say, a product management perspective, to make it designed with the intent for the beneficiary, for the users. How are people going to adopt it? And that is really key for scalability. So moving on, what are your what's your outlook with what we're seeing in the world of DeFi, which is very interesting because it's a whole new financial system of sorts, a very global pool of liquidity that is completely community driven and community governed in many ways.
This is very interesting. I'm an enthusiast in this regard to a degree, not a starry-eyed, but I'm an enthusiast nevertheless. I view that the potential is there definitely, and in this regard, most of these applications are built on Ethereum, which make them quite expensive in actual fact. But the fact that it's kind of do-it-yourself type of activity, I think, is very interesting. So I myself was a colleague of, a former colleague of mine, a student, if you wish, Arthur Sepp, have been developing something related to using decentralized finance and specifically automated market makers for the purposes of exchanging fiat currencies against each other, because I think that is an important area. I have to say that exchanging one stable coin to the other within sort of different tokens on the same Ethereum protocol, I don't really think is particularly interesting, even though people kind of do it all day long. But it's a little parochial, if you wish. But being able to exchange fiat currencies represented by stable coins, or if central bank digital currencies, coins, if they were to exist, that's something which is very appealing as far as I can see, particularly if you go into exchanging currencies which do not have natural crosses. So for example, if you want to exchange Indian rupee into Indonesian rupee, then under normal conditions you have to go through the dollar, but this way you can exchange it directly through a rule-based liquidity pool access. And that's frankly, I find quite beautiful, to be honest.
But that would require interoperability of sorts, a very, very deep sense of interoperability.
Super, yes, that is really correct. And at MIT, Sandy Pentland, Thomas Harjon, and myself have been working on this concept of interoperability for different blockchains, and for quite some time. Yeah, it seems like our definition sort of captured a little bit of a sliver of people's imagination, so many organizations use it. And I would say that this is, an example of this interoperability, as you say. That's correct. That's correct. And so more broadly, I think that there are limitations of what decentralized finance can do. And that is related to the nature of money creation and annihilation process. Because when a commercial bank lends money, essentially it creates it out of thin air. And when the money is repaid, it's destroyed. And so but interest stays into the system because it will be covered in the next never-ending circle of lending and, kind of borrowing and returning, that sort of thing. But with decentralized finance and more broadly with cryptocurrencies, this concept does not really exist. And many people think that it's a big advantage. I personally think it's probably a disadvantage of sort. But however it might be, true kind of lending of new cryptos is not quite possible. So all you can lend is, cryptos which you already have. And that's an issue in some sense, because it does not dynamically account for the economic activity and things of that nature. So essentially that transfers money, which is a super abstract concept and has always been. So money, debt, records that can be traced all the way back to the Shumers and the kind of Mesopotamia, 5,000 years ago. That is sort of not exactly what exists in decentralized finance and cryptos and in the narrow banking as such, right? So there is no concept of shrinking and expanding the money universe. You can only lend what you already have. And from that perspective, money becomes more of a material thing, like a chair. You can lend a chair to somebody, but then you will not have it. Same story with money. You have to sacrifice your ability to use the money if you want to lend it. So essentially it's a operation rather than creation and annihilation. It's more or less changing the velocity of money somehow through lending.
That's a very important implication, the velocity of money, which basically means how much a dollar bill goes around, how much a dollar is spent and earned. If $1 is spent and earned and goes around an economy 100 times, it could have the same effect as $100 in an economy. And what do you think there, given that, would be certain implications, advantages of the concept of financial inclusion also, with which there's a lot of excitement about for DeFi?
Yes, I mean, I think that that can help, definitely, because, when we think from the position of a developed country, in honesty, even though our banking system is it's a little bit past its prime, definitely, but it's still eatable, much like, in the supermarket, even though I'm not advising anyone to eat, food which is past its date, but I mean, in principle, probably it can be eaten, right? So the same way as our system is probably past its prime, but it can still be used. But in developing countries, in many instances, it's not really possible. And so from that perspective, they can leapfrog a little bit what we have, in developed world and build something dramatically different, much like in Africa, for example. They actively use, of course, cell phones, and there are very, very few landlines. So essentially, they kind of leapfrog this. Same story here. In principle, if the existing banking system is too hard to use, so that people have to go from village to the town to get cash and go back, etc., people will figure out ways and means of using, avoiding this as much as possible. And so from that perspective, DeFi can help. But other electronic tools can also help, like e-peso is the best known and very fascinating example, which is not strictly speaking a blockchain or anything like that, and highly centralized, but nevertheless very useful from that perspective.
It's interesting also to see, because DeFi is a tech stack, essentially it's built on the protocols, which are basically a set of rules for smart contracts, which allow automated transactions to occur. And on top of that protocol, you have the DeFi primitives of sorts, which are basically the basic tooling, like the stablecoins, the currency that flows through these functionalities, the rules on which smart contracts and these automated transactions will happen, because they're automated transactions that occur as soon as certain predetermined conditions are met. And on top of all of that, then you have the whole layers of specific applications, like which could be automated market makers, they could be lending, aggregators, and decentralized exchanges across the board. And where do you see, Alex, from the very basic component, thinking of the validators in the system, the layer one of the system, how do we ensure that these operations are governed in the right ways and operate in the right ways, because it's so decentralized and there's no central authority to
Yeah,
make?
that is a very, very interesting and important topic. So, there are kind of maximalist solutions, which are, sort of essentially, you kind of uncover the, identities of all the validators. I don't think these are individuals, it's more like companies and stuff, the same way as there are sort of very few individual miners in, say, Bitcoin protocol. They tend to coalesce into gigantic pools, right? So you kind of uncover that. That's sort of a little bit too dramatic. But one idea which, Lewis Cohen and myself have proposed in a recent paper in the International Financial Law Review is that essentially you create an interface which is oriented towards ordinary users, which is allowing you to do the usual KYC and AML and stuff like that. So in other words, if you really want to go very deep, burrow down to the sort of the primary, kind of the foundational layer, then probably you can use it kind of anonymously and stuff like that. But 99% of the users will use it sort of through this layer, and then they will be identified. So essentially, one approach which I think is promising is that you can probably do a lot in the kind of decentralized space, but when you on-ramping and off-ramping, that is certainly something which needs to be strictly controlled. So essentially, when you put the money into the system and when you want to take money out of the system, you have to be identified. And again, I mean, if it's $50, then probably not, but if it's like $10,000, then clearly. And that is something which I think is meaningful. So essentially, I want to just build a little bit on top of what you said very aptly about the structure of this DeFi onion, so to speak. At its core, it's something what I called consensus as a service providers. So the best known, of course, is this Ethereum, but there are other protocols like Cardano, Polkadot, and whatnot. So these protocols really allow you to establish consensus for a fee. And as I said, like the fee is too high probably for the applications which really kind of are of everyday usage, but they really provide consensus in a decentralized way without a third party, and that is kind of a modern marvel, so to speak. We need to still master these ideas. They're not yet fully baked, but that is something which I think is very, very promising going forward.
And finally, with respect to current events and what we're seeing with the whole situation with Ukraine or overall sanctions in general, where do you see the role of these decentralized systems and potentially automation, cybersecurity, and the decentralized world having a role?
Diana, I will be honest with you, it is very raw right now. It's sort of, I don't think the time is appropriate to discuss it, but hopefully this madness will stop before too long, and it would be possible to analyze it and figure out what it is it needs to be done. But what I do hear is that in Ukraine, essentially people are out of access to cash, and to a large degree same story in Russia, which is a little more surprising, but nevertheless. And in principle, in circumstances like that, this decentralized can potentially help, but it can also do harm. And also one other thing to be cognizant of, that we implicitly assume that everything can fail, but the internet services will be provided. So nothing can be further from the truth. So I mean, if God forbids,
still require
the whole thing can just be destroyed, and then of course all these edifices which are good for peaceful times can actually be under tremendous stress and stop working altogether, regardless of the quality of the underlying cryptography and stuff like that.
So we're going to move on to some of the questions from the audience that I've tried to answer through, and some of the questions that were submitted beforehand also. I think we've answered them through the conversation already. But moving back a little bit to how blockchains work and how distributed ledgers work. If we talk about, I got a question, do IP addresses remain permanently linked to each blockchain transaction? And what's the implication to address anonymity?
It's an interesting question. You know, if you simply do, first of all, vast majority of transactions anyway are sort of done through exchanges. That's what I was referring to when I said that, you know, decentralization has never been achieved in its kind of full promised strengths and so on and so forth, remains by and large a dream. But the other thing is that if you want it to be done anonymously, then, you know, clearly, you know, transacting through your ordinary computer would not achieve the goal. So that's why sort of those people who kind of really put a great currency onto, you know, being anonymous, you know, have to use onion routers and like that. So where essentially there is a breakage of direct link between, you know, the IP addresses and transactions. That's all right.
Right. And with respect to encrypting and encryption tools and the efficiency of the SH256 or different options for encryption tools, that's a bit more of a technical.
Well, look, I mean, yes, you know, secure hash 256, you know, is not the most modern. They're kind of different, newer hashing protocols, but the point is probably not that, but the point that it is very inefficient. That is exactly right, but I mean, that is by design. This is a feature, not a bug. So essentially, if you really want to use proof of work protocol, you do have to have something which is incredibly inefficient. Be it inefficient by way of doing calculation, you can go through different route and say expand an enormous amount of memory. You know, it has to be wasteful. If it's not wasteful, it will not accomplish its goal. So from that perspective, you know, this hash 256 is as good as any. I mean, you know, they look kind of the lower 128 and so on. They're too simple in some sense, and the more modern are not really needed. But secure hash algorithm, you know, like third generation is probably too much, but it is inefficient for a reason, so to speak. So it's inefficient enough to play the intended role. Having said that, as I already mentioned, that really results in enormous, prodigious expenditure of electricity by Bitcoin miners, and given the sort of climate change implications, that can be really an Achilles heel of the whole protocol, right? So that's why people are struggling to move to proof of stake or Byzantine fault, or practical Byzantine fault tolerance, or some other mechanism for establishing consensus in a decentralized system. But secure hash algorithm, if you want to use it for proof of work, has to be inefficient. That's a problem. That's the point. Okay.
What about anonymity in Bitcoin as opposed to pseudonymity? Could you define that better?
Yes, I could, with pleasure. You know, that as is explained in the book, essentially in Bitcoin, you only achieve pseudonymity, which means that if you operate, you know, using your public key as your address, and in Bitcoin, in fact, it's kind of wrapped in a few more layers, so to speak. Nobody uses raw public keys, but they are also hashed in their own right and so on. This is done in order to preserve, you know, the integrity of the system in case quantum computing becomes a reality. But in reality, when you kind of trace transactions, sooner or later, they will have to leave the you know, confines of the protocol itself and start to interact with the existing system, be it through the exchange, be it through some other means, and that's where the pseudonymity is typically broken. That's kind of the most interesting example is what happened very recently when 3.5 billion worth of Bitcoin were recovered by exactly breaking this pseudonymity by tracing a few small transactions, as a $500 Walmart gift card and things like that, and Airbnb expenditure and things. And that's where this thing is broken. So if you really operate solely within the Bitcoin protocol itself, then indeed, it can become much more anonymous and pseudonymous. But the point is that at the on-ramping and off-ramping, that's where this thing is broken.
Right, right. And I think we're going to have time for two more questions. One along the lines of what you're just saying. Do you think in the world of DeFi that the AML KYC burden would fall directly on the DeFi protocols, the DeFi?
Well, as I already mentioned, so our take with Lewis Coin is that I think it can be done at the interface layer. So basically not at the application directly, but on, like people who provide access to the applications. That's probably the most, the most reasonable area, or else on the on-ramping, off-ramping stage of using the protocol. I think that burdening the protocol itself with this would sort of, make it impractical and defy the purpose. So it has to be controlled either, kind of before you access it or after.
Excellent. And when we talk about risks, and I know you have a lot of thoughts and on lessons learned from the subprime crisis.
Right.
There's a question that says, according to the last report issued by the Financial Stability Board, there's several underestimated risks linked to Tether that recall the subprime crisis. What's your opinion?
Yeah, I completely agree. I completely agree. I think that Tether is a really strange concoction, and nobody really knows whether or not they do have collateral. And in fact, everybody knows that they do not have the collateral the way it's stated. Remember, I was talking about narrow bank and, as a, vehicle for storing collateral one-to-one and all that type of thing. This, of course, goes completely out of the window when you talk about Tether. Nobody knows where this collateral is stored, and nobody even knows what this collateral is and all that type of things. So, yes, Tether does present a major financial stability risk. And, that's on the people who designed it in the first place and those people who use it in the second place, right? Yes, nobody knows what's underneath, whether or not the collateral is there. So I cannot really say
that was a big question. And that's why the peg broke consistently. Yeah.
Yeah, that's right.
And maybe one more. When we talk about many exchanges in the world of Bitcoin and Ethereum being not as efficient and more expensive for many reasons, we have exchanges waiting for multiple confirmations before making the actual payouts. What do you think the leapfrog would be? Is there a new innovation needed? Is there an alternative? What's the revolution?
I think that the new innovation is needed, right? So I would say right now, my most interesting kind of, the ideas which I'm mostly interested in is in the area of NFTs, and also, as I said, real kind of application to supply chain management, things of that nature, right? So I am dissatisfied with the way exchanges operate. I find this whole thing going against the grain of this promise centralization. However, as I said, nothing is perfect. The whole idea was articulated and probably operated like that. So in other words, in the beginning, right? So if you were interested in Bitcoin, you could mine a few Bitcoins and you could spend them on pizzas and whatnot. And it was all fun and so on until it became big business. And then huge conglomerates are mining and, huge exchanges are providing services and all types of things. So it is still an open question where the whole thing will end, but I do think there is a big need for further innovation. Yeah.
Excellent. Well, we're at time, and thank you so much. The recording will be up as well as a blog post on it. And thank you, Alex, for your time and for this amazing conversation. Thank you, everyone, for joining.
Thank you, Diana. It was a pleasure talking to you, and we should be doing it more often. Thank you,
especially
everybody.
thank you for joining all the way from Abu Dhabi, given the time
Right.
difference.
That's right, but it's still not that late. It's 9 p.m. So
Mhm.
enjoy your day, guys. Goodbye.
Have a good night, Alex. Bye.